Hey guys, I am Hone Ty, the real estate guy. Hone's Loans, helping you escape your 9 to 5, and you are watching the Hone Zone. I have with me a special guest. He has been in the business for 34 years. I call him the godfather of real estate because he has helped so many people get into the business. And a lot of the big players you see in the Philadelphia market is because of Dave. Dave caused a lot of the people who
Don't
are in
blame me
business
for all
today.
this.
He caused the 2008. No, he single-handedly.
Yeah.
No, but Dave, you definitely have changed the landscape of the real estate market. Definitely in Philadelphia, you've helped so many people get started. You continue to educate. You continue to mentor. You continue to give back, and you continue to do huge things that people look up to. And so that, my friends, is Mr. Dave Van Horn. So Dave, welcome to the Hone Zone.
You make me sound really good.
Well,
maybe I get you to talk to Mrs. Van Horn.
Do you know who you're married to, ma'am?
Yeah, she knows.
She knows. She hears it too much, I'm sure.
No, it's all good. It's all good. But I'm sure I'm not the only person in real estate in the Philly area. Come on.
You're not the only. You're the person in real estate. That's the difference. That's the difference. So what is it that makes you who you are? How would you describe that? Dave, like I know I'm starting off high, right?
Yeah.
Dave Van Horn. Yeah.
I guess it's like values. I guess family values. I guess it would be my mom. I was raised by a single mom with 6 kids, and my mom was very, hardworking, religious. She ran a tight ship. She taught us a lot.
Right. And what did she teach you?
It was like do the right thing. She was always like, you had to, if you weren't on, you had to be earlier or you were late, you weren't on time. Like she was always like punctual. All kinds of stuff like that. And she just didn't put up with any nonsense. You had to be in school or you had to pay board. You had, there was no free rides or anything. And she would always, she had all of us working. She taught all of us how to cook. She taught all of us how to do laundry as soon as you could reach the washing machine. Like we all had chores. She was very, and she was great. She was great. Yeah.
Right. And then, is that how you continue to carry on your life? Is that what you do now?
I think that's a big part of it. I mean, you're influenced by where you grow up and who you're surrounded with. And, I had a couple of things that dramatically changed my world was, I tell people there's opportunities that come our way every now and then. I believe there's ones that catapult people if they take the right fork in the road. And we all have them, right? We all have a couple of these throughout our lives that were dramatically impactful, that redirected our lives into hopefully a better place. And it's those decisions that can catapult you. And one of them was my mom had convinced me when I was in 8th grade to take an entrance exam to a private school. And I was like fighting her on it. I was like, I won't get in. We don't have the money. And she's like, don't worry, you won't get in. Just take the test anyway.
Right. Reverse psychology.
And next thing you know, I get a 4-year scholarship. And then that changed my network. All of a sudden I'm surrounded with, more, kids with more advantage that, it's like going to Harvard, you buy the network to a point and the education, so it's kind of like that. And then I was one of the only siblings that completed college and things like that. So it was, it catapulted you to the next level. Not that college is everything. I don't mean that, but, it did make a difference and give you credibility. And then that led to something else. It was just like getting into real estate was a crossroad, or getting into the note business was a crossroad. Like there's different crossroads in your life, that could dramatically impact things,
Right. And a lot of times they're out of your control. They're not necessarily like you knew like that fork was coming up. You
have to be ready to receive the opportunity. So some of it is being ready and being prepared a little bit. And then some of it is luck, but some of it you make your own luck. So it's a little bit of both.
What was the biggest, like, or what was another fork? Like, let's go into details of a couple of the forks, because I think people have struggles with seeing the end goal. They look at what you do, and then they have trouble, like, how do I go from here to there? What you're saying is you went left and you went right.
He's an overnight success in the last 20
Yeah.
years. No, well, some of it comes out of adversity, right? So, like, I remember one time I got laid off the Friday before Christmas, and I mean, I literally went out in my car and like cried. It was one of those, like, I can't get the toys off layaway type moments, and it was like, and you know what? Well, it came out of that. I started my own company. I go, that's never going to happen to me again, and I started my own business, right? So I wouldn't have started my own business if I hadn't been laid off the Friday before Christmas, right? So sometimes those what seem like horrible times at the moment create something extremely different today. And that business I created, I kept for 10 years until I got hurt, and then that created something else. But my oldest son runs Van Horn Painting today, and it's 28 years, right? So that business would have never happened if I didn't get laid off that Friday before Christmas, right?
Right. So that's life happening for you, not to you.
Yeah.
There's a lot of
it felt like it was happening to me at the time, but sure.
Of course, it always feels that way.
Yeah.
And like Steve Jobs says, you can't connect the dots moving forward. You don't know that that trigger was actually going to be amazing for your development and everything else that you have. Right. You never know that.
And even some of the tough jobs that, I had a lot of crappy jobs over the years, whether, in construction and all kinds of different jobs, but it pays off later in life, and you just don't always know where it's going to pay you off at, whether it's managing employees or, I mean, even when I worked in fast food, there were so many systems and processes. And I look at my company today as we implement all these systems and processes and manuals and policies, and those experiences along the way all help out. You never know where it's going to come into play.
Right. And fast forward to today, what is your company now that you've learned all those systems? You had all of those things. Like,
well, my biggest thing. Leave it with my biggest thing is PPR Node Company, where we manage several mortgage investment funds, which focus on 1 to 4 family residential distressed assets. So we buy non-performing loans, REO properties, that type of thing.
So you're actually buying the properties too, or just the notes on the properties?
Well, we most of the time we're buying the notes, but like if you buy vacant first mortgages with borrowers that are deceased, guess what? You're buying properties, really. Sure, you're buying the loans technically, but
right. But there's nobody. Yeah, you're getting
indirectly. You're really buying property. Yeah. So and we buy and sell. We have thousands of mortgages, and I'll typically sell several hundred properties a year throughout the country.
Right. Most people that I bring on to the home zone, they're real estate investors. They're not note buyers. So they're moving property. So a lot of the viewers have no idea what the heck we're talking about. Like, what do you mean? What are these notes? So what is that? And what's a non-performing? What's the first? What's second? This, that, blah, blah, blah. Like, there's a lot there to unwrap.
They know. They just might not think they know. But if you own a property, you have a note and a mortgage on it, usually, if you have a bank involved. Unless you paid cash for it or something. That's really what we do. We buy a non-performing first mortgage or a junior lien. And that all that means is they defaulted, they stop making payments. So most people are familiar with mortgages when they buy a piece of real estate.
So with my real estate that I have now, with all the properties that I have mortgages on them. I did the BRRRR strategy. I refinanced, pulled all my money out. If I stop paying, is there a good possibility that PPR might be the ones who buy my defaulted notes? In
fact, I joke around with people when I'll explain what I do, and they go, "I still really don't understand what you do." I say, "Well, it's easy. Stop paying your mortgage, and you'll find out what we do. We would be the company reaching out to you to see if hey, what do you want to do? Do you want to stay or go? Do you that type of thing." We do some asset management, but we actually outsource a lot too. We do a lot of surveillance. We have asset managers that work for us. So we do a whole litany of things. And we invest in some other, business type ventures as well in the same space. Right. So,
Right. I read your book. You didn't start out at notes. You started out with properties, and you had a goal, right? You had a goal of 100 properties, and then you had this
one property a year in the beginning, and I would work my day job and sell real estate, and my real estate commissions were my money to buy the one property a year. That's how I was kind of. And then I was I want to get 20 free and clear, and then it became I want 100 houses, and then it was multifamily, and then it was all that stuff, and then I was in mobile homes. And,
Right. But you had this goal of at some point like 100 real estate properties, and then they were going to be free and clear, and then you were going to sell them off one by one, like kind of like
I'd retire. Yeah, I'd have 20 free and clear by retirement, at 65, and then I could sell one a year, or sell one a year outright, or hold the mortgage and do that for once a year for the next 20 years, and I'd be 85, and then I'd be dead. I hope. You get the idea. Now 85 looks young to me, but yes.
Right. But I mean, that's not a bad plan, right? If you
have it's better. It's a better plan than most people have, if you think about it, right?
Right. So
most people don't even have a plan. They can't even plan the weekend, right? So.
Yeah, I'm just planning for dinner. That's all I got.
Right. So yeah, it's not that. I mean, it's not that bad of a plan when you think about that. Hey, I'll work my second job. My second job will buy me these properties, and you get the idea. And then if I buy one a year for 20 years or whatever, and then pay them all off by retirement, because that was the theory. I started buying my first property when I was 29. So if I bought one a year for the next 20 years, right, do the math. And then if by the time I hit 65 or 60, they'd all start being paid off.
Right.
And then I could just, sell one a year.
Or peel one off every single year.
And not that crazy an idea at the time.
It's not. And let's say if the person who's
watching now, it looks crazy to me now, because I was like, that was dumb. Why would I do that? Because you're not. What happens is, in my case, I ended up with a couple million in equity. And I was working the equity as a private lender and hard money lender. If I didn't work the equity, I would have lost so much more. Because if you do the math, if you have 2 million in equity and you can borrow 80% of that, that's 1.6 million. If I borrowed at 4%, lend it out at 12 and 2 or whatever, I'm making a 10% arbitrage, which is 160,000 a year. And if I did that for 20 years, where I lived in Delaware County at the time, you could buy a house free and clear for 160 a year. You probably still can, for that matter. So you literally would have lost a house free and clear for 20 years by not working the equity in my portfolio. So.
Wow. So I love how you put that just so eloquently. You're like, well, you got 2 million, and you got 80%, and that's 1.6 million
line of credit against your equity or whatever.
Yeah. But no, that makes a lot of sense to me, following along that, $160,000 a year. I mean, that's a lot.
That's what people are losing by not working equity in their portfolios sometimes, because they're in this, I want to pay down debt mode. But really, your properties aren't meant to be banks. They're meant to be investments. And
this is why you're the godfather, because you have this wisdom of see, if I were to say that, some people might be like, well, Hone, you haven't been around long enough to understand that not having debt is a good thing, and yada. But you're the guy.
It's about leverage, and it's about who are you protecting, and it's about safer buckets and asset protection. And paying down a property does not protect the investor; it protects the bank.
Yeah, I heard you say that before.
Once it's paid off, then it's different. You could move the property into a trust, or you might be in a trust anyway in the beginning, but you could, reposition the asset or something. But really having, it's all about leverage and using leverage in a good way and in a safe way. And there are safe ways to do it. And there are better ways to save money and protect money than in the equity of a property. Because really the equity in a property is kind of exposed, to be honest with you.
So it's really a conversation of what are you actually talking about? What are you protecting against? So we're saying that by paying down the mortgage, but not paying it off, just paying it down, the loan to value
it just protects the bank. It doesn't protect you necessarily.
Right. And so there's a risk that the bank could be the one that puts you in jeopardy. Like they could call the note, they can foreclose.
I mean, it's simple, right? Like if I have a $500,000 property and I owe $100,000 on it, that 400 grand in equity really is protecting the bank more than it's protecting me. And why I say that is, God forbid I get, lung cancer and I'm out of work for 9 months and I come down to you, the loan officer, and say, I'd like to live in my house till the rest of my life now. And you go, well, you've been out of work. You can't get a loan. Right. Whereas, or if, I don't know, I have a teenager that is all, hopped up and drives his car into a gas station and blows it up. And now they want to sue me. An attorney would come after that
equity in the house.
Whereas if I had a line of credit against it or something, that would give me, say I had a second mortgage for up to 90% combined for the first and second. So now I owe $450 against the $500,000 house at the county courthouse in, I don't know, Westchester. You go look up the records and they go to sue me. They go, oh, he only has 50 grand in equity. It's not worth suing for that.
Right.
As opposed to 400 grand in equity. That's worth suing. So, and then the other side is the line of credit would give me equity, even if I had, or liquidity, even if I had a zero balance. So it's asset protection through debt and liquidity, which is very important, especially in times like now, where you're entering recessionary timeframes for that cycle. Now I'm not smart enough to predict, a pandemic or anything. I'm not trying to allude to that. But, and I'm not necessarily saying I can always predict how and when a recession will hit or how long it'll be or when exactly it'll hit. But I can always,
what the recovery looks like.
I can be prepared all the time if I want to be, if I make that a goal to be prepared.
Right. Well, Dave, what was it like to live through the first pandemic in 1919?
It's funny you say that because I talked with my mom. I'll probably call her tomorrow or Sunday, and I'm actually going to. Now she wasn't around during the pandemic. It was kind of hush hush back then, from what I hear. But I do hit her with those kind of questions, like, do you remember a time like this that it was this much uncertainty, or wartime or whatever? Do you remember your parents talking about the pandemic? 50 million people died back then, I think. So. Do you remember any of that? Do you remember hearing stories? I'm going to actually ask her some of that.
50 million people. I can't even imagine that. That's a lot. That's a lot. Wow. Okay. Well, pandemics aside, what do you got going on? Because I understand that pandemics can be bad things and they can be good things, depending on who you are and what you're doing. And maybe not good thing, but
pandemic's a bad thing,
it's a bad thing. It is,
and I do believe that this is a little bit unprecedented. It's really not an economic. It's really a health crisis that caused an economic issues, right, with liquidity for sure. And I do believe until we have some kind of a health solution, we won't really have an economic solution, which they seem to be getting closer and closer every day, whether that's with treatments or testing or, eventually a vaccine, before we can actually get all the way back to some sense of normalcy to where we were before all this happened. So, but at the same time, in my business, I'm in the distressed mortgage business. The number one economic indicator to my business is unemployment. And we all know unemployment is at unprecedented levels right now of, how high the unemployment is. And the probability of, yes, we will get back to work at some point. Will everybody go back to work? That'll be the question. I don't really believe everybody will go back to work. Unemployment was at like an all-time low there for a while. And these are some of the things that were much different than 2008 and 9, because my business was around before the crash. And then we went through that crash, and it was definitely different. It probably took the government 18 months to respond. Here, the government's responded in 18 days, right? It's a much quicker moving. It reminds me almost of like a hurricane, but it's a hurricane that didn't go away for 90 days or 6 months or whatever it's going to be. I don't know that I'm not smart to figure that out, but it seems like it's here for a couple months for sure. And then, but I think there's going to be some collateral damage, right? Especially in the job markets. Business won't be the same for every business. You can't tell me hospitality and restaurants and cruises and sporting venues are going to be the same going forward, or crowds. There's going to be a new normal, and there's going to be a reset and a recalibration of things. And the unemployment will create more distress. And we're already seeing it in the wholesale markets where assets are trading back a little bit. There's a lot more uncertainty. There's longer mortgage moratorium, foreclosure timelines, ejectments. You're seeing courthouses close. You're seeing townships close. You're seeing it's hard to pull permits. It's hard to get re-inspections. You're seeing virtual closings. You're also going to see people that are out of work, and you're a loan officer, right? So when they come back in 6 months and they go, I want to buy a house, and you go to do a verification of rent, verification of employment, a verification of mortgage, you're going to have a lot of people that aren't buyers anymore. They got to wait a good year or so and be back to work, right? So I think there's a possibility that there could be fewer buyers in the future. And you might see pricing drop. We're already seeing hard money lenders lowering their ARVs as much as 20 and 30%. So you're seeing reserves of interest payments going up dramatically. I'm seeing 6 even to 12 months interest payments and reserves for a hard money loan. I'm seeing margins widening, right? Rates are going up already. Well, why is that? Uncertainty into the future.
Uncertainty and risk, right? Yeah, people are thinking
are they going to be able to get as much for that property 6 months from now, that kind of thing. And there's a lot of uncertainty there, right?
Right. So let's look at the comments real quick. You have some fans. Look, Bill McCafferty, the legend, Dave Van Horn is the man. Right.
What's up, brother?
And then look at this, Steve Lloyd. My brother. I owe everything I have in my life because of Dave Van Horn.
I don't know about all that. No, I think that's your mom that you.
Dave took me to my first real estate meeting and changed my life forever. Steve Lloyd. Boy. But of course he said, Dave, I need $5 million.
Yeah. Yes. And he's probably not the only one that needs $5 million right about now. So Sarah
says, Dave, wealth of info and easy to understand. Wow. And then Damian, yes, no buying is awesome. Preach on. Preach on. You got no fan. Chris says Dave Van Horn is amazing.
All right, man. I'm gonna have a big head by the end of this.
And people are listening. Great point on asset protection through debt and liquidity and equity stripping, as it's called, right? Equity stripping. Yeah. Pull that equity off. Yeah. So whether or not you take the action, whether or not you take a mortgage for the thing or a loan for the whole thing, or you get a HELOC or a line of credit against it, on paper, it looks the same. It looks the same. Yep. So no, very, very good strategies. Now, the thing that I have insight on is the PPP loans and the SBA loans.
Yeah, we just got one.
And I've issued a couple, so I'm really happy. And the borrowers are like forever grateful. They're just like, oh my God, thank you so much, because they're like, if I don't get this loan, I go out of business. But then I think about how many people.
I don't know that we would have went out of business, but you're right. Like we applied for the PPP loan, and we're just under 30 employees, and I'm able to keep all the employees on, which is a good thing, because when we go back, eventually go back to work, we're going to be working overtime, because we're going to have all this pent up work from the foreclosure work that's all backlogged and things like that. So it would have been a shame to have to furlough people or whatever, and I'm able to keep those folks on. So it is a blessing.
Do you have your people working from home now?
Yeah, well, a lot of us were able to work remote anyway, and we did have a disaster, like disaster recovery type plans. I didn't know I would be using it for a pandemic, but it's good to know that it works. And no, we're fortunate, and we're not in a retail business where we have like a storefront or anything like that. Right. So we're really fortunate that we're able to continue. I'm actually working harder than ever in the last few weeks, which is kind of interesting. Yeah.
Yeah. A lot of the people that I'm interviewing and a lot of people that I talk to, they're saying that they're busier than ever, even though they're home. So it's interesting, the dynamic that we have. Some people are like couch potatoes 24/7.
I was going to say, the other interesting thing is I'm 4 minutes from my office, and I literally usually only went in the office a couple days a week. I'd only go in like 2 days a week. So now instead of being home, 5 days a week, I'm home 7 days a week. So it's not that big of a deal, except for my wife.
Where are you located? Where are you located again?
We're outside Philadelphia. My office is in Berwyn. Yeah.
Okay. So local.
Yeah, local. Yeah.
Yeah. So you were telling me before we started the call that you are working on $100 million fund.
Yes, we did. We launched a $100 million fund. And what's kind of neat right now is we're approaching our buying season. And we're working on a couple joint venture things. We got a lot of interesting stuff happening right now. So yeah, we'll be actually really ramping up in the next week or two, where you're going to start to see us come back around, which is somewhat unusual in this market for some people to think about raising capital. But, we're in the distressed debt space, and we already know the third and fourth quarter of this year are going to be pretty brisk for us, I think. So
what are you doing with $100 million? What does a $100 million fund do?
We do a lot of things.
Most people will never see that in their lifetime, but you see that.
I mean, a lot of it will be geared up to buy non-performing first and second mortgages in the upcoming months. Short term, though, that's not the case, because right now there's a lot of volatility in the non-performing note space, and most of what we're looking for today, my partner just bid on a collapsed bond, for example. Things like that. So you're seeing the distress create opportunity. You're seeing margin calls as well. Right now, we're focusing, believe it or not, on non-QM products, which are mortgages that you can't sell to the GSEs, the government agencies like Fannie and Freddie and HUD.
Yeah. Okay.
So a non-QM loan would be like I don't want to call them the old liar loans, but it would be like a loan that is not a traditional loan that could be packaged up. It might be for a self-employed individual or something that, something like that.
Low credit score.
It could be some reason it doesn't fit into a package like that. And there's a lot of opportunity there because there's really no secondary market for that right now. It all fell apart. There's been a lot of margin calls. So there's a lot of opportunity. There's, our trade desks are telling us, like $6 billion in that product. And it's really trading back dramatically. Prior to COVID was, they were really close to par, and now they're trading way back, right? So there's opportunities like that you'll see. I think the other opportunity we're seeing is in the hard money space, as the aggregators, like the Torox of the world, they're still there, but they're making their requirements much stricter. In fact, the people that are aggregating hard money loans up to Wall Street are actually on the hook for some of the equity of that, like if they redefault. So they're on the hook for some. So you're seeing it changing. It's getting much stricter. A lot of the competition's fallen out of that space where, a couple of months ago, everybody and their brother was a hard money originator, where you're going to see that all start to fall away. And there's going to be fewer and fewer hard money lenders out there. I don't know if you're seeing it already. So there's some opportunity in that space, especially if you're a buy and hold. And then, what we're looking to do there is we raise some cheaper private equity and we marry that with some institutional money. And then we're able to hold those hard money loans as opposed to aggregating them up to like a Torox, for example, and selling them off. So we're able to hold them. And that's one of our plays right now as well. We're working on some stuff in that area.
Will you sell them later? Like you're going to hold them for a little bit?
No, hard money are typically short term, right? They're short term, months, maybe 12 at most, usually on the majority of them anyway. And then we'll just keep recycling that money. Yeah.
Right. So you're just going to hold the note until it's maturity, and then the
borrower's
going to refinance or whatever. Yeah. Oh wow. Okay. So that's what somebody with $100 million does with $100 million.
Yeah. And we're not on the front end of that. We're not the originators, right? So our partners are the originators. We're the back office side of that. We're the back capital of that. Yep. Right.
Okay. Now somebody who is like, okay, enough talk with that $100 million. Who cares, right? Because it's like it's so above and beyond outside of the scope. What should people do today? Like regular real estate, and I say regular real estate investor. There's no such thing, right? But what are people who are maybe not raising funds the way you are, but they're just they're buying a couple of properties here and there. They're doing maybe a flip. What should people be looking at? What should people be doing? How should we act today?
Well, it depends what asset classes you're talking about too, but a little bit. Yeah. But some of it's just patience right now because of the volatility, you're not going to see any. You're not going to see a lot of necessarily deals right away. You might have to be patient for a deal, but now's a great time to be sitting in cash or access to cash for sure. Hopefully you had taken care of some of that business prior to this, where you have access to cash, lines of credit, things like that, because theoretically they could start calling lines of credit, reducing lines of credit. You might see some bank tightening. So some investors I know are accessing their lines. They're moving their money into different bank accounts at different banks, things like that, so that they have access to cash for when the deals appear. It may take a few months, say 6 months or so, where you'll start to see some more distressed opportunities for even for the regular street real estate investors with, fix and flips and things like that. They could be a little tight right now, but in another couple of months, I think you're going to see a lot more, fix and flip opportunities, things like that. Now, the question will be, will prices drop, or will there still be a brisk market? Because you kind of eliminated the spring real estate market. It's unprecedented times. It's actually pretty hard to predict right now, because when we open things back up, whether it's in the summer or into the fall, my son's a contractor, and he's like, Dad, it's like we're having 2 winters this year, Right. Like, if you think about it. And it's kind of like that with real estate, because you know how you have a spring market and a fall market in the Philly area, and summers are usually a little slow, and then the winter is a little slow, like in the middle of the winter. And, it'll be interesting to see, how do we jam all these deals in just to a summer fall kind of thing going on, and you might see a better summer market than normal, because I think people might not be traveling quite as much or as far or as often as they normally would, especially coming out of this. They might be short on cash now because they've been out of work or whatever. You're going to see a sense of pulling back, or I know I'll be doing less business travel. I'll probably be doing more Facebook Lives, right? Hey, nothing wrong with that. And I think people are going to be checking their expenses, and they should be right now. You should be watching your budget, whether it's your family budget or your business budget, what's coming in, what's going out, what can I cut back on, And I think everybody's kind of doing that right now. They're taking their time. They're looking at things hard. What are we wasting money on? What subscription don't I need? You're seeing a lot of that, I think. And I think it's going to be a new world order too, of how people do things. We're going to be looking for things that are cleaner and safer and this and that, I don't know if I'll be going to a rave anytime soon,
Yeah, we're gonna have what Jay Scott called the PTSD, right?
Yeah, I don't know how many Fish concerts Bill McCafferty's going to this year, but he might cut one out or something.
Yeah, I think a lot of people are going to cut a lot of those things out, and those businesses are going to be really, really impacted.
Yeah, it's going to be different, and you're going to see it with tenants. I mean, the one thing I like about the note business, which you might not want to hear about. I own properties too, and I used to have like 40. I'm down to about 15. I still have. I'm fortunate. Half of mine are government rent, so I'm pretty safe there. And some I've owned so long, I'm in a pretty safe. I'm blessed, right? I'm pretty lucky.
Right.
Some of the newer investors, I don't know that they're that lucky. If they're barely making payments on the house they live in, and their tenant stops paying rent. I was talking to a buddy of mine who's heavy in the multifamily, and I'm hearing upwards of 25, 30% aren't paying rent. Wow. I don't know about you, but most vacancy factors from a commercial point of view is, 5, 10%, right?
5, 10, yeah. Yep.
Yeah, nobody's factoring in 30%, right?
25, 30, crazy. No way.
Now, I was a property manager for a long time, and, I've been in real estate a long time. And I'll tell you right now, if a tenant misses more than 2 months rent in 34 years of managing property, guess what my stats are? I had one person that came back after being more than 60 days delinquent. And it was because they hit the lottery or something. So once you're 60 days delinquent, it's over with a tenant, right? They're never getting caught up. So when you see times like now where, we're saying, hey, you don't have to pay your rent. You don't have to pay your mortgage. You don't have to pay your taxes. You don't have to do it, and you get a stimulus check in the middle of the month, and let's go buy some weed, right? So it's just a weird time, right? Like, so I think there's definitely caution there. And one of the concerns I have about the properties, that's why I think you're going to see, especially investment properties, you're going to see them coming back up for sale. Somebody's not going to be able to handle that because of that. I don't know that they're set up for that kind of vacancy, or it's not a vacancy. It's just not a non-payment of rent like that. And then on top of that, oh, by the way, you can't even evict them. You got to wait. There's a moratorium where you live. So, I don't know if everybody can take a 30% hit in their rents for 3 months or 6 months.
Right.
A lot of people, I don't know that at some point it's going to impact anybody or everybody. The cool part about loans though, I'm buying loans at a discount. We're modifying everybody's loan anyway, because they're all not performing. And if somebody's not making payments for a couple of months, it's very similar to someone filing bankruptcy. And then all of a sudden they come out of bankruptcy and Bill McCafferty will know what I'm talking about. It's almost like a couple loans file bankruptcy is really what's happening it's a blip. And what happens is the loan payments don't go away, right? They're getting tacked onto the back of the loan.
Yeah, they're just getting, right.
Or they're worked into a new modification plan. Well, that's much different than my rental properties.
Right, because you're
not paying rent. I'm never seeing that money again. So that's a big difference. And that's one of the things I like about the note space is in some ways I feel like I have less risk there. And then the other thing is, I think right now is a weird time. If you haven't sold a property by now or quickly close soon, well, now you're kind of leaving a seller's market, and will we be entering a buyer's market in the future if prices drop? It'll be interesting to see. You heard what Fannie Mae said yesterday, right? They think prices are going to drop 20% on real estate. Well, if that happens, right? Well, now it's more of a buyer's market. Maybe we should become buyers in the next 6 months, picking up properties from real estate investors who weren't prepared to take the rental hit or whatever, or somebody that's in a distressed asset that doesn't want to go to foreclosure, right? They want to sell their house real quick or whatever. So I think there's going to be a lot of opportunities for everybody across the board who have capital or access to capital, whether it's buying notes or property in the near future. Same way with multifamily. I think you're going to see, a lot of the multifamily was overvalued. It was a lot of crazy appraisals, low cap rates. Oh, rents are going to go up forever. Yeah, we're not even able to collect rent, let alone raise the rent, right? Like, are you kidding? So you're going to be in a whole new world order. There's definitely somebody that's not going to be able to hold on to an apartment complex, or definitely not be able to meet their metrics or their business plan, Because
they're all trying to do value add. Everybody bought last year value add. Oh, in 5 years, we're going to be able to sell it for. They're
not going to be able to do value anything. They're not going to do value add because they won't be able to make their mortgage payment.
Right.
Right. They didn't factor in that I'm not going to get my rent for 20, 30% of the tenants, right? So that's going to eat up your value add money quickly.
Yeah. So it's
going to be interesting times, but it's going to create a lot of opportunity. But I don't know that but it creates pain along the way. And I'm not, high-fiving anything by any,
Right.
I'm not that kind of.
That's not, and that's not, I guess, what I want us to be portrayed as. Like we're celebrating that things are going bad, but I am pointing out that the market changes and it's shifting because of this reason. We just happen to have a solution, and our business is geared up to do better in certain seasons. And this season is you've been waiting for 10 years. Like your business is geared up to win during this time.
Yeah, I mean, it's probably been 2009 to 12 where we were able to really see, we saw some really cheap assets after the last crash, right? And there's a lag in distressed debt. It could be a couple years. A lot of the distressed assets we buy are a couple years delinquent. So it might not hit for a little bit, but I think you're going to, it is an interesting time because you have so much government intervention and stimulus. Like it's really hard for me to get my mind around some of this stuff, or even economists, because they're pumping in so much stimulus.
Right.
What are the unintended consequences of some of this stuff, right? If you pump in all this money, is the value of my dollar less? Is it, when we come out of this and get back to work, or is everybody going to raise their prices, right? From the restaurant all the way down? Like people are going to try to make up for lost time and being out of work for 3 months or 4 months. Because, think about it. I lost revenue for the year for a quarter of my year or more. How do I make that up, right? So everybody across the U.S. has kind of taken a hit in some way. And I think we've all incurred additional costs, right? Additional expenses. So is everybody going to be trying to make up for that? Plus, you have all the stimulus hitting the market. I'm curious to see, what the influx of all that extra printing of money, so to speak, does, as well as, interest rates. The Fed's playing games, the government's playing games. What are going to be some of the unintended consequences?
So if we have this inflation, as you're talking about, does that mean that my property values are going to go up?
Is it inflation, deflation, stagflation? That's what Jay Scott was saying the other day. And, he's right. I'm scratching my head. there's so many different moving parts right now. It's hard to get your arms around all of it because you're kind of seeing a little of this and a little of that, and where's it going to shake out, But
don't you have economists that work for you in your office?
Yes, we do.
Don't they have all the answers for you? Come on, what do you pay them for?
Actually, they do. They
have an answer.
I do have a market watch forecaster in the office, and pretty much he thinks unemployment is going to shake out at about 5 or 6% once it settles down. And what were we at 3 or 4 before? So you're definitely going to lose a few points. You hear V-shaped, U-shaped, L-shaped. He was kind of U-shaped camp, leaning back a little bit towards the V because if we get good news, will we get back to work sooner? So it's really all how long are we out? How long are we out of work? How much will the government assist? Will the government help the secondary banking markets? That'll be interesting to see. So far, I don't really see the government loving real estate investors and helping them out. I don't think we're at the top of their list. No offense to us. But I just get that vibe, and you kind of saw it with the EIDL stuff, and there's too many people that probably have a bigger need than bailing out a real estate investor. I don't know that we're top of the list.
We're people too, though, Dave. We are people too.
Yeah, I get you, but I they have a different order of priority, I think, or a different agenda, So I usually don't bank on governmental stuff. I usually focus on taking care of my own business, and if I get anything else, it's icing on my cake. That's the way I kind of look at things over the years.
Okay.
Yeah.
All right. So now, are you just telling people wait, just wait, see how this market shakes out?
Well, I think you have to be patient a little bit. I wouldn't just run into a deal that isn't really a deal because, if I'm seeing something that's trading, or selling 20% below normal or 30, maybe. But if I see it's only trading, 6 or 8% below normal, is that enough to ride out this longer timeline? Are the ARVs and future values going to be there? Is it enough? So I know if you lower prices a little bit, it can carry out quite a bit of timeline, especially in bulk purchases. I know we do that because we do a lot of modeling, but just be careful out there. It's just you don't want to be doing business like you were 2 weeks ago or a month ago. 2 months ago,
yeah.
It's going to blow up on you. That's all I'm pointing out. Like, we're not making the same offers today that we were making 2 months ago. No way.
Right.
Our offers have dramatically changed on the assets we buy.
So the assets that you do buy with the $100 million fund, you're giving opportunities to different people, like accredited investors and things like that, right? So people can invest in your fund, but they can also purchase notes that you're buying, right? So you're going to be.
That is something we have dialed up. So a lot of our revenue has shifted, right? Because right now, about 18 states, there's foreclosure moratoriums. In the other states, we're still actively foreclosing and selling assets, and then some states we're doing virtual closing. Some states we can still close regular real estate settlements. So it's a whole mix throughout the country because we work everywhere. And but as far as note sales, I have been dialing that up because I'm anticipating, a shift in my revenue buckets. Right, I anticipate there's going to be some moratorium that impacts my revenue from some of my normal buckets, like my REO bucket's a big revenue bucket for me. Well, I might not be able to sell as many REOs at the sale or the 90-day post sale due to some of the moratorium. So I'm being proactive about that. So one of the things I'm doing is I'm dialing up note sales, right? And I'm fortunate enough to be able to shift things like that. And I think it's going to be something we can, hopefully easily get through and then be back to work just like everybody else.
Are notes easy to buy? It's like, is that open to the public? Because I know being an investor,
you don't have to be a high net worth investor.
Right.
For us, you just have to go to our site and register as a note buyer. And, once you get approved to be a note buyer, you're off and running. We only sell to entities, that type of thing. But once you meet the
what's your website?
If you go to ppr.noteco.com, you can actually go there and register as a note buyer, and we push out notes every week. Most of the notes we do sell through trade desks, but we do sell notes, just to retail investors every week.
Right, and for somebody who's never bought a note, it depends on what the the value of the note is and everything else. But like, how much is a note? Like low end, high end? Where is it located? Yeah, I know it's a big mix.
Most of what we sell is probably between 10 and 70 grand in that range.
Oh, really? Okay. Yeah. So that's pretty affordable to somebody.
And you're buying payments. And if you want to learn how to do that, you can reach out to Bill McCafferty. He'll help you.
You're putting a lot on Bill here.
I don't know if Bill's thanking me or
yeah. Well, he did comment on the fish concert comment that you made. He said, "I'm going to zero." It's not
I know. He's probably got his headphones on listening to Fish. It's not the same probably. So it's yeah, you can't have as much fun.
Yeah. So if somebody's buying,
crowd's half the fun, right? So
it is. It's not the same. So that experience, I think people are going to miss that. So at first people were like, "I'm not going to anything." And then eventually people forget and people don't care as much and people aren't getting sick. And then it goes back to normal eventually. Could be 10 years.
We hope it does. But yeah, I mean, yeah, unfortunately we're in a weird time and yeah.
And none of us have been here before. So if anybody says that they know, they don't. You guys are not privy to any of the confidential information.
Unless you're 100 years old or something. I don't know that you've seen it. So, yeah.
Right. And even if you were 100 years old, you were 1 year old when it happened.
Yeah. Plus, I don't think you had government stimulus then. So it's different.
Right.
But, I think we'll get through it. We'll make do. And hopefully we'll all learn something and come out better from it.
Right. The notes that you're selling, you're selling first and seconds, and then you're also selling
primarily. A lot of them are seconds, believe it or not, that we do sell.
Okay, so you're selling seconds, and then a question that's difficult to answer, but what are you selling it at? How much on the dollar?
It does vary. That's a good question. I guess that most of them are, I don't know, in the 8 to 15% range, depending on how many payments are left and equity and where they're at and all that. There's a lot of variables, but I don't price them.
Okay.
Can you tell? I raise capital.
Right.
But yeah, most notes today are probably sold in that range, somewhere in there, based on safety and equity and position. And
so you're saying anywhere from 8 cents to 15 cents on the dollar?
8 to 15% return type is.
8 to 15% return. Okay.
On that investment, yeah.
Okay.
Now, we do have a note warranty at my company, so if you're
what does that mean? You're the first one that I've heard say that.
If your loan were to redefault, we'll actually buy it back, and our warranty is investment principal minus payments received. So you wouldn't lose your capital if you bought a note from us.
Right. Just time.
Or if you bought a note from somewhere else, you could. Yeah.
Yeah.
Money. Yep.
Wow, that's fantastic. It's like who else is offering that 15 to 8 to 15% return? That's fantastic. I see why you have $100 million fund.
Yeah. No, that's true. Yeah.
So if seconds are way different than first, right? And these are performing ones that you're selling?
Yeah, these are reperformers. Yep.
Reperformers. Okay. Okay. So they were delinquent. You worked it out with them.
Modified, and then we resell them after they season. Yep.
Got it. Okay. So then they're 8 to 15%. But then, how long is the warranty for? Is that for the life of the loan?
Yeah, it's for life. Yeah.
Oh wow! So you're really getting 8 to 15%.
Yeah, we're partners with you. We don't leave you hanging. And if you wanted to keep the asset and foreclose, we would assist you with a foreclosure attorney in that state. If we have one in that state. Yeah.
Oh, that's incredible! I had no idea that you did all that. That's really neat.
We've only been doing it for 13 years. Not like.
You're not kidding. All right. So what? And then so you went from real estate to the note business. You transitioned, right? So then
back in 2007, I went from selling about 75 houses a year as a Remax agent to about 7, and was fortunate enough to be introduced to the non-performing note business and said, hey, what side of the fence do we want to be working on in this downturn? And I would have either been a starving real estate agent, or I could go into the note business. At the time, I chose the note business, and it worked out.
Gotcha. I have a question. What is the average term of the note from Jeremy?
Well, most modifications are in the 15 to 30 year range on the modifications. So they can be shorter, though. It's not unheard of. Most of what we sell is in that range. I would say most of what we sell are over 10 or 12 years of payments left. We don't really sell most of the super short term. We don't sell. They're really weird to price.
Yeah. So I'm assuming that the 15% is priced accordingly because of the inherent risk in the note. So what is it about the note? Like, is it because of the position of the first, the LTV?
Yeah, sometimes
the
the return is higher by the position or the equity in the note, or how many payments are left, because there's an amortization schedule, right? Even on the modification, and a lot of them are front end loaded with interest, right? So, and most people only keep a mortgage 5 to 7 years in the U.S. for all mortgages. So the banks figured that out a long time ago, right? So if you have a 30-year amortization schedule and it's set, and you take it the first 7 years, it's all interest, right? Generally speaking, it's mostly interest, right? So why do you think banks are so profitable?
Eager to call you and say, "Hey, you
profitable for the other day when their shares are all down." But yeah.
Yeah. Do you prefer first or second, or you just don't have a preference? You're just like, one has this kind of risk? And
I guess when I was new and naive, I might have. Today, I look at them as, I like both. It's like saying, do you like the mountains or the beach? And the answer is yes, for me. Some people like to put it in one category or the other. Me, I look at them differently. First mortgages, I can deploy more capital. The margins are smaller, but I can deploy more capital. And there's technically a safer lien position, so to speak. Junior liens are more lucrative, but they're more work, right? They're more touches. And a good analogy with that I give sometimes is at the end of last year, we did a trade for $30 million. It was 145 firsts, right?
Okay.
Which would an asset manager in first liens could oversee 100 million in loans. In junior liens, we spent like $3-4 million on like 600 or 700 junior liens.
Wow.
Well, that would require 2 asset managers. So a lot more work, touches, a lot more assets, but a lot lower value, but higher yield.
Oh, okay.
Now you could argue, well, I make more money with seconds, and we do. We're very good at that. We have a lot of data on that, but they're also more work. So, and you could say, well, which one do you like better? I don't know. I like both. They're just profitable in different ways.
Got it.
Right?
So
if I want to deploy a lot of capital, I like first.
Right.
If I want to make a higher return, I like seconds. So I guess it depends on what kind of beer I'm drinking that day.
And I guess if you don't have a lot of money to deploy, then maybe seconds is where to be at.
Well, that's the other thing. Seconds, you have a limited amount of capacity, right? The second lien space is less than $1 trillion in the U.S. And especially up until recently, there wasn't a lot of junior liens trading, right? They weren't writing a lot of junior liens for a while. There wasn't a lot of delinquency in the market. There was a lot of strict underwriting. So you were seeing that market shrink and shrink and shrink. And same with first mortgages. That's about an $8 trillion industry. So you can see it's about 8 times bigger than the junior lien space. So you'll see more consistency of deal flow in the first lien space typically.
Right. Now, I know that people listening to this who are real estate investors, they're liking what they're hearing, because with notes, there's no tenants, toilets, or trash, right? That's
you'll miss that. You won't be able to, go to Home Depot and stand in line.
Yeah. So you don't have to
to
deal with any of that. And then I think
on the REO side, if you take a property back, but we usually don't even with our REO property, I'd say half of what we sell is at the foreclosure sale, and we might sell another 20-25% in the first 90 days or so post sale, as is after clean out or whatever. So we rarely rehab. Rehab's a big risk for us. And I think that's going to be the thing going forward too. I think major rehabs are going to be more risky than doing a quick cleanup and flip than a major flip right now. And I think you might want to be aware of that, right? You might, that long build time or that long renovation time, it's going to be a dangerous game in the next 6 to 12 months, I think. So.
Right. The transition also, when you went to note space, you were also able to scale faster because you're moving paper and not.
Yeah, you can definitely scale notes a lot more quickly than I could. Like going out to deploy 100 million in properties is a little more work, right? and you need a lot more boots on the ground. Whereas just owning the paper, I don't necessarily need, a lot of renovators, right? Picture if you owned, 100 properties locally or a couple hundred properties locally. Well, we're liquidating several hundred properties throughout the country. It's a little bit, I'm not saying it's harder or more challenging. It's just different. And, I have a really good REO agent on staff, for example. Like I could go to her, Amy, I could go to Amy and say, I have 1,000 houses I need you to blow out of here. And she could handle that. Most of the people on this call, their heads would come off if they had 1,000 listings on their desk. They wouldn't know what to do.
Okay. Yeah. No.
They'd be overwhelmed. They wouldn't know where to begin with it,
Right.
So
now,
it's a special skill set and special. That's why an REO agent is different than a regular real estate agent.
Right. The thing with real estate, and we touched upon it in the beginning, is like you can buy 20 houses and then they get paid off over 30 years, and then they also appreciate, and you can hang on to them forever. But notes don't work that way. They don't have this long-term appreciation.
They have other neat characteristics. So
can you go into that?
Yeah, a couple of examples. Like there's notes I have where I can collect for 3 to 5 years and sell that note for the same price I could sell it today for. Right. So, and they also have what's called phantom appreciation, which I bought a loan at a discount because it didn't have a lot of equity behind it. And now equity comes back in the marketplace and my note's worth more. Well, I didn't really do anything.
Because the LTV is better?
Yeah, or it becomes better. So the collateral becomes better, and then now my note becomes better. And I didn't do anything. The other thing that can happen sometimes is pay history, right? So I got a loan, it was defaulted, it's reperforming now. And it, once it's reperforming for 12 months or 24 months, it jumps up in value and it becomes almost worth par again. Well, that's a pretty unique form of appreciation as well, right? So a lot of people don't really talk about that. Now, the one thing it doesn't have is depreciation. But you know what? If I'm making a hell of a lot of money in notes, I can go buy a building if I want depreciation. It's not like, I don't live in a vacuum, right? I can.
Right. You can do both. You can do everything.
I do a lot of things. I mean, I have plenty of write-offs, you know what I mean? So it's really, that's different. That's how are you structured and all that stuff. That's another equation. I'm not saying I don't pay attention to that, but I like having multiple buckets. My note bucket's been good to me. And, I'm happy with notes. I'll probably always own real estate, but I also want to make my life easier and scalable. And really it's about leverage and being able to maximize that leverage and efficiency to really build wealth and cash flow and things like that.
So I was looking at my life and seeing if I wanted to restructure things, and I have my rental portfolio, and I keep hearing your voice in my head about all of like going to Home Depot and dealing with the tenants and the whole bit. And I'm just like, why do I do this? Why do I do this? Right.
How much and then I think stand in line at Home Depot?
Not enough. Not anything. Right? Not anything.
It's nothing. I have nothing against that stuff. I mean, it's just like when you.
No, there's nothing wrong with it.
When you stop being an employee and you're first self-employed, because my first business was that way. It was revolved around me, and I was my own contractor. And, you think it's great at first, but really all that was different was I just had freedom of my schedule. I actually had more responsibility, and I was more of a slave to my job than, instead of working 8 hours a day, I was now really working 24 hours a day.
Right.
I'm responsible for all this crap. And I had freedom of my schedule, but I was really obligated to all the builders I worked for, all the apartment complexes I worked for, all the private jobs I did, so I don't know that I had freedom in the true sense of the word as to when you have like a real business that can run on its own, whether you're there or not. It's different. Or I have an investment that is passive and I don't have to do anything. So they're all different. And I think I see a lot of real estate investors, go, woohoo, I quit my job, and now I have a worse job, Yeah, I don't know. Yeah, you might be making more money and you might have a little more freedom of schedule, but is really that the ultimate goal? Because if I plucked you out of could you sell me that business? And how much would you get for it? And could I pluck you out without me having to do what you were doing?
Right.
The answer is no in most cases.
The quote that you said that was so profound a little while ago that you commented was, the more you work in your business, the less it's worth.
Yeah.
And I was
true.
like, oh, that's so good.
The more you work in your business, the less it's worth. It's a fact.
Yeah. So then I was thinking, like, if I were to restructure my business and I still wanted depreciation and appreciation from a building, that I would buy the coolest A-class building that maybe doesn't necessarily cash flow all that well, but I have my whole portfolio of notes. So this way I can have the best of both worlds. It's just, I can take all my depreciation because it's highly valued and the whole bit, but most of the money comes from the notes. What do you think about that?
Notes are pretty passive. I mean, even my rental portfolio today, like some of the hardest hires for me, obviously I was a painting contractor years ago. So one of the hardest hires was hiring a painter, right? Because nobody does it as good as me. Right. And I was a property manager, and that was a very difficult hire as well, was hiring a property manager. Today, I look at it like, wow, what a waste of time that would be for me to do that today, because that task is nothing against property managers. I was one, right? But it's an hourly rate, right? It's whatever, I don't know what it is today, 25, 30 bucks an hour, whatever it is. But what am I making today is dramatically different than that, obviously. But so why would I want to be dragged down into that job or task? Now, it doesn't mean I can't do it or I don't know how to oversee it or any of that. But and there's nothing against being, an asset manager, an REO agent, these are all different jobs and things I've done over the years. But it's really, what's the best use of my time? What's the best use of my, how I leverage my knowledge and my skill set, and what am I best at? And then how do I hire the rest? And sometimes we get trapped in the mediocre stuff that we can do. Even though we're slightly good at it, is it really the best thing we should be doing? It's really that one thing. I love the book by Gary Keller. What's the one thing that'll deem everything else unnecessary or,
Yeah, no, it makes a lot of sense.
And really catapult you. And that's the same way with one of my coaches was that way. He was like, what one thing is going to really catapult you in the next few months or in the next year, personally or business wise. He didn't say what 10 things. He said what one thing is really going to move the needle for you. And then what do you like to do? What are you good at? And what, obviously, hopefully you can make some money at.
Make money from it, right? That intersection of those three things.
Everything, or it brings you joy or happiness. It could be that.
Yeah. Speaking of good books, Dave.
Yeah, there you go.
Do you know of any good books?
Real estate investing. No, I'm a little biased, but
show them what that book is. What's it called? Real estate note investing?
Real estate and note investing. I'm sure a lot of people already have this, maybe. It's a great intro book into the note space if you're not familiar with it. A lot of real estate stories in there as well.
Right.
Yeah.
And for those who didn't catch it,
note business, whether they know it or not, because they're dealing with hard money lenders and mortgages and one of the things that I'll kind of leave you with this. One of the things I figured out early on was if I can get more efficient with it's a finance driven business. And if I can get more efficient with the finance end of the real estate investing, I won't need to own as many properties. I won't need to deal with as many tenants. And I can create efficiencies by using leverage and mastering it. And it's proven to, hold true that there's a lot of money that can be made in the finance end of our business. And to just ignore that and act like it's not there, for me, wasn't, I'm glad I didn't let that happen. I'm glad I chose differently.
Right. We do have a question. Do you ever buy first position notes done with seller financing?
I have, but we as a company don't. We only buy institutional notes. Me, personally, I have over the years, but it's really not my cup of tea. There's actually brokerages that do that, Colonial Funding, and there's plenty of places that buy seller financing. So if you are thinking of doing it, it's a good idea to find a seller finance broker to get their criteria of what they buy before you create your note is a good strategy.
Right. I actually work with a few note brokers that would buy that. Now, of course, they're going to buy it at a discount, but they're offering your service. Yeah. And for those who didn't catch the joke, that was Dave Van Horn's book, right? That was his book. He wrote that book. Again, it is the real estate note investing book. And it breaks down how you got to where you got to and what you're doing now, and also how to look at first and seconds and non-performing and performing and all of those cool things. Because there's a big difference between first and seconds.
Yes. And you know, it's a big world too. I mean, just like real estate, right? Real estate's a huge world trying to figure out, you know, some people are like, where do I get started? Well, you know, what are you good at? What do you like to do? And it's humongous, right? It's just like real estate. It's everything from cemetery lots to REITs. So
Right.
how do you tell someone where to start in real estate, right? It's like, it's
Right.
mammoth, right?
Right. Right. Okay. Well, Dave, how do people, how do they get your book? Where can they find that book?
Oh, it's on Bigger Pockets. And if you want to catch up with me or ask questions, I'm on Bigger Pockets literally daily. You can ask a question anytime. So if you go to biggerpockets.com, they have books for sale there, and mine's one of them.
Right. And then again, if people want to buy notes, whether first, seconds, whatever you guys are selling, go to
notes at pprnoteco.com. pprnoteco.com. You can go there and register. You can be a fund investor if you're a high net worth person and you want to do totally passive. You can do that, or you can actually buy a note and register as a note buyer. And we sell notes every week in our email newsletter. Yep.
Right. And in order to qualify to be a high net worth individual, you have to make $200,000 a year if you're single and $300,000 a year if you're married, or have a net worth of $1 million, not including your primary residence. Is that correct?
Yes, you're pretty close. Yes.
What else? What else am I missing?
Well, if you're an entity, it's different. You know, there's some other rules, but yeah, you got it. You pretty much got it.
Yeah. Yeah. So if you're nowhere close to that, get there and then call Dave. All right. Well, Dave, any last words for the viewers? Anything that you'd like to leave them with?
Stay safe, be a little patient, and I think the deals are coming, guys. And be ready. Get your cash ready.
All right. Well, there you guys have it. You heard from the Godfather himself, Dave Van Horn, and you guys have been watching the Hone Zone, and I am Hone, and we are out. Peace.
All right, brother. See you, man.
See ya.